There we go. Now it's starting. Thanks for coming out today. We're going to jump right into our meeting. It's about how much does your financial advisor cost? There's a lot of information on the web about this stuff, but it's all in different places. So I spent like the last week putting together all this stuff, and it's took a little longer than I expected. Every one of these, I think, going into the week, I'm like, oh, this will be easy. I'll take like 2 hours and I'll put it together. It always, like, you get down the rabbit hole and it takes me like 2 days, what I thought was going to take a couple hours. So just a disclaimer at first, we do show some projections in here, and none of this is actually a recommendation by us. Like, I don't know your guys' personal situations. I've met many of you for the first time, so I don't know, what your needs are. A lot of this is obtained from, like I said, sources I found online. I kind of assume it's accurate. It's from legitimate sources, but I don't guarantee it's accurate, and it might not be accurate a year from now. So just the intro, we're just going to talk about how financial advisors are compensated. A lot of them are commission-based or fee-based, or which is a hybrid, or fee-only. And then we're going to talk about fee transparency, and then we're going to go into the details. How much I've laid out how much each one of these different financial advisors cost over 30 years. So like if you start investing in women today, 30 years from now, most people save for retirement. Most people save around 30 years. How much could they cost you over that 30 years? And then we're going to talk about, at the very end, we're going to talk about a fallacy that a lot of these advisors will tell you is that, yeah, our fees are high, but you shouldn't care about that because we're doing active management. We're beating, we have a chance to beat the market. They're trying to get you away from index investing. And we'll talk about that fallacy. So the first, we're going to talk about what is fee only. What is fee only? There they are. Well, welcome. What's up? Okay. Y'all want to grab breakfast? Y'all are good?
Don't worry about it. Hey, son, keep going, man. Don't worry about it.
So first we're gonna talk about fee only versus commission advisors. So there's fee on the other end, the opposite end of the spectrum. Fee only, they only get a fee based on what you pay them. It's pretty transparent. And on the opposite side is commission. They get commission for selling you products. And in the middle is a hybrid called fee-based. So they get compensated by a fee you pay them as well as from products they sell. So the advantages of fee-only advisors are that you're going to typically have more tailored personal service. They're going to typically be more credentialed. This isn't always the case. There's certainly commission-based advisors that are CPAs or CFPs, but on average, your fee-only advisors are going to have more credentials because that's, at the end of the day, they're selling themselves and they feel the need to get more credentials, whereas they're not behind a big firm. They're going to have less conflicts of interest because they're not trying to push you a product. They're not trying to sell you insurance when you might not need it. And generally they're going to have more, they're going to offer more robust services. Like we'll get into estate planning, tax planning, we'll even get into some of that. And because they're not trying to sell you product, they don't have pushy sales tactics. You'll find that I'm pretty anti-sales. You won't get any emails from me or calls asking you to follow up. If you come to my meeting, great. If you learn something, great. I hope you come back. That's kind of my sales pitch. The disadvantages of fee-only advisors, typically they have higher fees. They have high investment minimums. The fee-only advice started really in the 1980s, and it's very little unchanged because most of them who started it are still in the industry. They're just now getting to where they're retiring, and they have not had the need to change their business model. Even though technology's come a long way and there's reasons that they can lower their fees, they just haven't had the need to. And then a lot of times they'll make you move their discretionary only, so they'll make you move money to a custodian that they prefer, and that can be time and hassle. I don't know if you guys have ever rolled over a 401k to an IRA, but that can be a pain. And so the next slide is just going to talk about fee transparency. So this is kind of laying out how the advisors charge. So for fee-only advisors, they state their fee. They charge you a percent of assets under management. They'll send you an invoice. You'll see how much they charge. And then from the investments that you're invested in, there's a behind the scenes fee that you'll never see. You'll get a big prospectus and a bunch of disclosures on it, but how many of us always read those 42-page disclosures? Not many of us. So that's your total fees are 0.8 in the fee only column, and in the commission column, all their fee is in that behind the scenes kind of diminishing your return fee, so it's less obvious. It doesn't, like a lot of people, like almost up to 0.25% of people who hire an investment advisor say that they think their advisor doesn't charge anything at all, which, I mean, logic would tell you that's not right. Everyone's getting paid for something. And so how it works, how these fees work is on the commissions, like if the investment returned a pre-fee return of 7%, that behind the scenes fee reduces it to 5.5%, essentially, right? Whereas if you were in more index funds and you had a low expense ratio, your post expense return is 6.8, and then you pay on top of that a fee to the financial advisor for the invoice you get. So it's a little more transparent. But now we're going to get into the heart of it. We're going to get into the heart of everything and how each of these different. I didn't put a page for all 20 different custodians. I have it though with me if you are curious about a particular one, but I put in like the big names. You'll recognize all these names. So Merrill Lynch charges an advisory fee, a stated advisory fee of 1.3% on average to their clients. And the investments that they're going to put you in has again, behind the scenes expense ratio of 0.68%. So that means you're paying 2%, nearly 2% on average with Merrill Lynch. These are the highest fee guys. So then the annual return, assuming you had a 7% annualized return over the 30 years, your return is down 2%, down to 5%. And so if you invested, so all these show like if you invested $500,000 up front, like day zero, you invested $500,000 with them, over 30 years, what does that look like and what could it have looked like if you had no fees? So the graph below shows if you invested $500,000 today and earned a 7% pre-fee return, if you had no fees, you would end up with $3.8 million in 30 years. That's a healthy number. With Merrill Lynch, the red line is the fees you pay. You're going to pay them over 30 years, $660,000 in fees. That's a big number. And so the gray line is the impact of those fees. You lose. It's more that you're losing more than just the $660,000 because of compounding. So you lose $1 you lose today is a lot more in the future, right? So you're actually losing $1.6 million over 30 years with Merrill Lynch.
Wow. I never looked at it that way.
Yeah, that's how. Unfortunately, that's how the industry is set up, and they know what they're doing. They know that people are pretty sticky too. Once you go to Merrill Lynch, a lot of people just like to set it and forget it, right? Like they're never gonna ask their advisor, how much are you charging me? I don't understand it. You guys take care of it. Okay, yeah, we'll take care of it for you. Don't ask about it. I can't tell. I've had a lot of people come over recently, and they haven't heard from their advisor in 5 years. Like they haven't talked. Like they haven't received a call. They have to call their advisor to talk to them. That's to me, that's not the way to do business.
Ours actually come out of Kansas a couple weeks ago to visit us.
That's awesome. That's service. So, like I said, there's a big variable to the kind of service you should provide. And I would argue if you're paying him, he should come down. You know,
yeah.
That's good. Ameriprise, another big brokerage house. They are, again, they charge an advisory of 1.34. They actually have a higher advisory fee than Merrill Lynch, but they hide some of their fee in the expense ratio. Their investments are more costly. Their total fees are I'm sorry, I got it backwards. The reason they're lower than Merrill Lynch is their investments are less costly. They're actually 0.43, so their total fees are 1.7, $1.5 million difference over 30 years. Charles Schwab, 1.5% total fees, 1.3 million difference over 30 years versus what you could have had if you earned a flat 7% return. After their fee, you're only earning 5.52%. 30 years, you only end up with 2.5 million. And you've paid that advisor $538,000 over 30 years. These are all pretty similar, so we're just going to run through them quickly. Fidelity, 1.36. Advisory fee of 1.1%. Ending balance of 2.6 million versus your potential 3.8. So that those fees cost you $1.2 million over 30 years. USAA, this is a big one. They are actually, these guys are actually one of the lower ones. These are some of the lowest. These are all fee-based. All these companies aforementioned are fee-based, so they can get commissions from products as well as advisory fees. USAA is 1.07. They're actually relatively low. They'd cost you, but they'd still cost you nearly $1 million over 30 years. And but you'd only pay your advisor $400,000 of it. And so the industry average, this is the industry average for all advisors. So the industry average is around 1% for an advisory fee, and the average expense ratio of every mutual fund and ETF in the universe is 0.64% according to Morningstar research. So your total fee is 1.64, and they'll cost you $1.4 million over 30 years. Now we ran through that kind of quickly. Does anyone have any questions on how any of that was calculated or the impacts? Again, the blue line is just your total potential. The gray line is where you'd actually end up if you had 7%. Now, of course, that 7%, we're about to get into that, is where people will argue, well, you're paying me that high fee because I can get you more than 7%, right? And we'll get into that in a little bit. And so then, this is my firm's fee. My advisory fee ranges from anywhere from 0.4 to 0.8, depending on how much money you have. And that's my highest fee. I offer discounts off that. And over the 30 years, if you were provided no discounts, my average fee over those 30 years would be just under 0.6%. And my average expense ratio for people is around 0.1%.
So you use mutual funds?
I do. So the way I work, a lot of these advisors, like I said, they'll make you move money to a custodian that they choose, and they won't offer advice on your 401k, for example. They'll only take money that you rolled over from a 401k. And so there's a conflict of interest there too. If you have a great 401k at your employer, they're going to want you to roll that over to an IRA to them, even though you have great investments there.
Yeah.
So I say I don't like that conflict. I make recommendations for your 401k. If you have a good 401k, I'm going to leave it there, and I'll still charge on that balance. But if you have better investments there, then I can get you in an IRA. Why wouldn't we leave it there? So, long story to your question, yes, I do invest in mutual funds when offered by people's employers. Does that make sense?
Say that last one.
If I recommend that you leave if you have a good 401k and I recommend you leave your money there, there's mutual funds there that may have they act like index funds. They have very low expense ratios generally.
Okay.
And so yeah, I do invest in mutual funds, but I don't get into the active management.
Okay.
I don't invest in actively managed funds for reasons that we'll get into in a second. So I'm able, on average, I've cut people's fees from, some people pay over 2%. I've seen people pay 2.1%. I started a guy this year and he's paying 0.9 now. So I've saved him 1% a year. That's a huge difference. Like anyone that tells you that you shouldn't worry about even 1/10% is fooling you. Fees are the #1 impact towards long-term performance. And I put this in here just to show the difference between commissioned advisors and fee-only advisors. And so just to prove that point, I went ahead and downloaded their fee disclosures from Edward Jones. So Edward Jones, fees from clients. This is, I don't know if any of you guys have read this. It's like a 42-page document. I can tell you nobody reads it, all right? Their revenue from clients includes commissions, markups, markdowns on your price when you buy or sell securities, the upfront sales loads that I just talked about, fees based on the value in your, this is the advisory fee, the fee that they charge you outright. Interest on your margin accounts. If you have a margin account, they can charge you interest on that. Miscellaneous fees for IRAs, wire transfers, return checks, transfer on death services. That's right. If you die and you want to transfer your account to a beneficiary, they charge you like $100 to do that. So they're always trying to nickel and dime you with fees. And so that's just the money they receive from you, right? They also receive money from third parties. This is where we get into the conflicts of interest. They receive money from other people. The investments they recommend to you, the products they recommend to you, they get a back end. They give you a product, you pay them money, you pay the guy selling the product money. That guy's product turns around and gives Edward Jones money for selling you the product, a commission. So this is Edward Jones revenue from third parties. Revenue sharing based on the products you sell, payments. As you can see, there's a bunch of different ways they get paid from third parties. All these are potential conflicts of interest. And I couldn't fit it on one page, so it's on the second page too. It's continued. All right. So those are all the different types of fees they receive from third parties. And so then on the next page I put the fees I receive from my clients and the fees I receive from third parties. The fees I receive from clients are just the two fees I told you about. I get revenue from my assets under management fee, and I get revenue from my financial planning fee. That's it. That's how I make my living. That's what you pay me is what I make money on. And so the next page shows my revenue from third parties. Again, I'm fee only, so it's nothing. There's no conflicts of interest. If I did, I'd have to disclose it. You'd see a million disclosures from me, and that's why I don't do it.
So you are a fiduciary?
I'm a registered investment advisor with the state of Texas, and I'm a fiduciary.
Okay.
That's right. All registered investment advisors. As a point I didn't want to bring up, it's kind of the water's got a little muddy now. So everyone that I've shown on this page, none of them are currently fiduciaries. There was just a law passed in April of this year where in 2 years they have to become fiduciaries unless they can disclose, excuse my language, they can disclose the hell out of why they don't need to be a fiduciary. So it's called a best interest contract exemption. The rule, they lobbied the law. The law came out last year. They gave them a loophole, essentially, right? So they can, as long as they disclose why they're doing it and let you know, they're going to have to show you more stuff. But again, does everyone read that? Does everyone go through that 42 page?
Fiduciaries, but they aren't.
Exactly.
They'll let you assume that they're fiduciaries without.
Right. So, but there is a repercussion though. So now, if after that disclosure it still wasn't in your best interest, you have the right to sue them in court, whereas currently today you don't. Right now they're under what's called a suitability standard. So as long as the product makes sense for you and you need it, like, so say, I'm 35 years old, I need an IRA from them, that can be justified. Whatever costs I need, I still needed that product. It's still doing me more good than not.
It's still very vague.
Right. But now, are the investments in that product appropriate for you? Are they right? Are they the lowest cost investments? That's what they're going to have to prove now. So that's the good thing about them. The bad thing is that, they can disclose and disclose and disclose. The bad thing for them is that now they can be sued in a court of law.
So they have to disclose all of this stuff that you need.
They disclose.
Do they disclose on this?
They disclose this now. But the difference is, so even though they disclose, those are just fees that they charge. Those fees don't have to be. They don't have to search out the best product for you. They can get money from, if they want to sell you insurance, they can get money from that product. Now they have to say, was this product in your best interest? Is there another product out there? Yeah, I made 5% on selling you this insurance product. I could have made 4% selling this product that was actually a little better for you. That's where the line is now. Now they have to do that other one. But they can still disclose, even though the fee is still too high, essentially.
Or if they say that this stock is a great stock for you, it's just because they were given a bunch of stock in a,
Right. Exactly.
you know, to take somebody public.
Previously,
Then they,
previously you couldn't sue them for that.
yeah,
Now you can sue them.
Yeah.
Now the hard part, of course, is right. And most people, or even finding out that they own, that there was a conflict of interest, right?
yeah.
You have to go read through that whole document. I guarantee you it's not going to be in big print on the page 1.
Yeah.
It's going to be on page 35 in size 6 font.
It won't be really written in English layman's terms.
Right.
Yeah, we were with Morgan Stanley 15, 18 years ago, and
Not a good thing.
they were more, I mean,
I have their fees if you wanted me to bring them up. I have their
There's a
average.
reason we love them.
I know what it cost us.
Yeah.
It was a lot.
It was high, right?
It was pretty.
Yeah.
Yeah. Especially when the guy put us in all.com type stuff.
Yes.
I mean, we were
We lost.
almost fully invested in .com.
I can't tell you.
How many others like us?
Yeah.
We were stupid. I mean, we didn't know.
But is it stupid? You're not in the industry.
Yeah.
You shouldn't have. That's the point of the rule. The
Yeah.
fiduciary rule is that you shouldn't have to know. They should be. You're paying them money. You're paying them money to do what you think is what's right for
Best
you.
for you.
Right.
Yeah.
And they're not. They don't have to do that.
Yep.
So, again, I was going to get into the. I just put the same slide in here. We kind of already hit on all of it again. Why fee only is better. More personal service. I meet with people at least 2 times a year. In the first year, I meet with them 4 times a year. With Edward Jones and stuff, I wanted to get into that too. Like I said, they charge you a commission up front. Now think about that, just logically. If I invest you in something, I get my fee up front. Am I likely to care about how that does 2 years from now? Am I going to meet with you?
No.
I don't care. If I get it, I'm paid every year by you. I'm more likely to want to continue a long-term relationship. Want to make sure if I mess up, you're going to leave. Like, so I need to do what's right. Because that guy's already got paid. If you leave, it doesn't matter. And so what I try to do is, like I said, the disadvantages are that there are higher fees. There's high investment minimums for fee-only advisors. Like there's no fee-only advisors on the northeast side of Houston. I'm the only one on the northeast side, to my knowledge. Most of them deal with very high net worth people in the Galleria. Like you search fee-only advisors, you're going to find a bunch of fee-only advisors in the Galleria. A lot of them set up shop there. We were talking about it earlier. I work out of my house. Part of the reason for that, I've had the question, why don't you get an office? Why don't you? Someone from the neighborhood asked me that. I said, well, I can get an office. You want to? If your fee's just going to go up. I mean, are you going to come into my office and are we going to meet at my office, or are we probably going to meet at your house? I'm always going over to people's houses. I've never had someone ask. I have a home office, just like Janet, and I've never had someone say, it's more convenient for me to drive over from Katy to meet at your house, right? I'm always my car has a ton of miles on it, unfortunately. So that's one of the ways I lower fees, is that I don't have an office. I can't say I'm not going to try to get an office later, but generally the reason why my fees. On the next page, I show how I try to eliminate the disadvantages. So I don't require you to move custodians. I have no investment minimums. If you have $1 to invest it, I'll take you on, simply for the fact that I'm passionate about what I do and I think it'll lead to better business. Like the model's different. I'm wanting you to get comfortable with me, get confident in my abilities, and then eventually you'll be more trusting and invest more with me. My fees are 40% less than the industry average. So of those people in the Galleria, the industry average for those kind of advisors is 1%. My highest fee is 0.8%. On average, my fee is around 0.6.
Have you ever worked for anyone else in the industry?
No, I interviewed with, I was previously I did accounting. I was a CPA before this. I was with one of the big 4 companies, and then I went off and did mergers and acquisitions for a private equity company. I got kind of sick of traveling, started a family, and so I wanted to start off on my own. I've always wanted to do this. I've always kind of known the problems with the industry for a long time. And I went and interviewed with all the big fee-only advisors. Like if you name a fee-only advisor in the Galleria, I've talked to them. I've sat down in the room with all of them. And I was kind of disenfranchised by it because they asked me the same question from a different point of view. They asked me, have you been in the financial industry? And I said no, but I've passed my CFP exam already. I'm a CPA, I'm credentialed. I think my background speaks for itself. I promise you I'm at least as qualified as your top advisor here. And they say, well, how much money do you think you can bring to our firm? The question every one of them asked, it was still sales driven. They were still looking for, have you been in the industry? Can you talk to clients? Can you bring more money under our umbrella? And frankly, 4 of them were above the age of 60. And they were going to, like I said, a lot of these fee-only advisors down in the Galleria are transition planning. So they're all retiring. That's one of my big sales pushes too. Is like if you go get a fee-only advisor in the Galleria, he's not going to be there in 5 years. It's certainly not going to be there in 10 years. They're all retiring, and they're transitioning to a planner that you don't know, that you're not familiar with. So no, I didn't go work for one of them.
I was just curious.
Yeah, no, it's a good question. I get that question a lot. I started it back in 2012, my own firm, and that's what I've been doing. So.
You did indicate you don't change the custodians, but who do you normally use?
So my top 3 custodians are, Vanguard is my favorite, Fidelity and Charles Schwab are the top 3. And mainly because those are the top 3 in terms of assets too. So I maintain a list of investments that I recommend for all those custodians. And if you already have money there, perfect. Let's not move. We'll do whatever. But again, if you have money at, what's another one? Like,
T. Rowe Price.
yeah, T. Rowe Price, TD Ameritrade, any one of those, I can certainly provide recommendations for that. Now, I can't say that I won't recommend you move them, like especially if you're at T. Rowe Price or Edward Jones, like I'm probably going to recommend you roll that over to Vanguard or somewhere else where you can get, so again, we can lower your fees. So.
I don't want to take everyone else's time, but there are a few that I would be curious on what the fees are, because we have some monies in different places.
Yep.
So maybe afterwards.
Yeah, like I said, so I'm which one can I
JP Morgan, John Hancock, and T. Rowe Price.
I have those.
Okay.
So you want to shoot me an email? Well, I'll my email's in here.
The bulk of ours is in JP Morgan.
Okay. Theirs is you're gonna be 2% range.
That's what I thought.
Yeah.
And we're not. We just moved there.
They're in the Merrill Lynch stratosphere, actually. Yeah.
So is Wells Fargo, right?
No, Wells Fargo is kind of in the middle.
Really?
Yep. Yeah. They're going to be around 1.5, I think.
So tell me, in say the last 3 years, what percentage has your customers' portfolios increased over, say, the last 3 years?
Just like you're talking like an annualized return that they have?
Yeah. Just if they had $1 million,
that's
how much is it worth?
That's a good question. The reason why that's hard to answer is because I have people from the age of 30 to the age of 75.
Yeah, I mean their risk tolerance is different.
They're all my person who's 75 is invested in ETF bonds, majority, and my person who's 25 is invested in equities. So it's going to range from, this year my average return is around 4 or 5%. Like I said, I'm going to meet the market. I'm investing in index funds, so I'm not professing to beat the market. So whatever the market's done, that's what I'm going to do.
So last year before, were you above 0?
Oh yes, certainly. But I don't want that to be misleading.
Yeah.
The market's been above 0.
Right.
If the market was down in the last 2 years, like if it was 2008 and you asked me that question, yeah, I lost money. You know, we're matching the market generally. So
The reason I ask this, in 2014, 15, we lost money, and just now in February, March, April, May, when the market has took a little run, have we got up above what we put in
14 and 15, you should not. I did not lose
3
money.
years ago?
14 and 15, you should not have lost money.
I think we lost where
Yeah, we
we
did.
didn't make much.
You might have lost money. Certainly, the time period, the market kind of tanked last quarter, the last half of 15, and then it came up. So I could see where you might have taken a dip there.
Yeah.
But 14 certainly should have been positive. So, but again, so I think my real, if I'm just, so I've pretty much shot down my whole value, right? I'm just going to meet the market. I'm trying to match you to the market as close as possible. And I think that's
index funds. That's what you're going to do.
I think that's value, and my other value comes in estate planning, so in tax planning. So because I don't make you move vehicles, like I'm letting you keep vehicles, I like for people to have a diversified set of accounts. Like ideally, people would have a tax advantage account, you know, a traditional IRA or 401k, and they'd also have Roth accounts, and they'd also have brokerage accounts. Because there's benefits to holding, you don't want to hold all your assets in retirement tax advantage accounts.
Yeah.
There's advantages to holding equities in brokerage accounts and stuff like that. So while all these advisors will disclose the hell out of, they don't offer any kind of tax planning, I'm an RIA, I can do what I want, I'm a CPA, we will have tax planning within your portfolio. It's, like I said, it's, aside from fees, it's the next biggest thing that's going to impact you. And so my real value, like I was saying, my real value comes in lowering your fees, lowering your taxes, and then also estate planning. So I work with people on, I have an online, it's called an Everplan. It's like a digital estate plan. It's a to-do list. I see it, you see it. We walk through during every one of our meetings. Where are you on your will? Is your will still up to date? Every year we talk about your will. We talk about your advanced directives, insurance is in there, power of attorneys, even stuff you don't think of, like, you know, should the worst happen, how do I want people to care for my pets, you know, stuff like that is in there. What bills need to be paid. There's even, it's pretty in-depth into the estate planning side of it.
And digital assets,
Exactly, so,
because people overlook that.
right, like if I passed, can my wife get in? She doesn't probably know all the accounts I have, right? Can she get into them? Does she have passwords to get into them? You know about all of them.
But so many don't. So many don't leave digital assets and it's totally overlooked.
Right.
So I find that.
Yeah, one of my clients is a widow, and I had forgotten the value. She saw the value in it immediately. When I opened it up, I went over to her house, and she's like, "Oh my God, I wish I'd have had this 5 years ago." You have no idea. It was hell going through this 5 years ago, and I just brought, like I said, I started in 12. I brought her on 2 years ago, and I just introduced her to this Everplan, and she was a big proponent of it. Because the guy had stuff everywhere, and she didn't know it. She was lost, essentially.
When my dad passed away, he thought he had things, he had all of the stocks. He held all of
Yeah,
the
like
stocks.
in his office, in a,
To get all of those
Right.
transferred, it took months.
Yeah.
Months and months and months.
makes sense to go through it sooner rather than
Everything
later.
went to her, everything was set up, but actually getting everything done, it was awful.
Yep.
Awful.
That's why it's actually a recent startup, this Everplans. All this digital estate planning is kind of new. And she went through the same thing. Like, you read her bio, she's out of New York. She went through it because her dad passed, and it took her like 6 months to get everything settled. And she's like, there's got to be a better way. So that's a big, and that's one of the other big values that I'd say I have is really I'm not going to tell you which, and think about it. If these guys at Edward Jones, Morgan Stanley, whatever, could tell you the best investment to invest over the next 30 years, wouldn't they be trillionaires? Wouldn't they be the most richest people in the world? I'm not lying to you and telling you I know the best investment. I'm saying let's match the market, let's be prudent about it, and I'm really just a shield from you coming to me if you get nervous and it's 2008 and you're like, oh, everything's down, sell. No, it'll be back in 3 years. Right. Let's be smart about it. I'm more like a barrier between you and a bad decision is how I would look at it. And so this last page is just that active management fallacy. So this shows These are actively managed funds. Their success rate versus their benchmarks. How many of them beat their benchmarks over 1, 3, 5, and 10 years? So how to read this is, you invest in a U.S. large cap mutual fund, and actively managed. So they're going in and picking, I think Facebook's going to do good. I think Apple's going to do this quarter. They're constantly changing. How they do, did they beat their benchmark, which would be like the S&P 500? 57% of the time, after 1 year, they failed. This is in 2015. So in 2015, they failed. Now, if you go back 3 years, it gets worse. The longer, they might get lucky in 1 year and you might beat it in 1 year. But how many of us are invested for 1 year? We're in it, most of us for the long term, 10 years plus. All those numbers, only like less than a quarter of them, most of the time, beat the index. So that's why I push index fund. This right here is why I do it. I'm much more data driven. Like I said, I'm not gonna ask for your email address, for your phone numbers. If you're interested, I think you'll call me, and if not, great. I hope you enjoyed breakfast. So that is it. And like I said, I'll have the rest of there's like 6 or 10 other companies that I found the fees for, and I'll put those up online. And your specific ones, if you want to email me, my emails are on the front. If you just remind me the 3, and I'll make a note to send it over. That's it. Any questions?